Hello and welcome to a very special webinar by ExtractAlpha in collaboration with Smartkarma. I'm Valerie, and today I have the pleasure of welcoming CEO and founder of ExtractAlpha, Vinesh Jha, and Smartkarma's CEO and co-founder, Raghav Kapoor, who will be sharing with us how quants gain alpha by leveraging unique alternative data sets. Before we start, a bit of standard housekeeping. Please feel free to send in your questions for our speakers throughout the webinar using the Q&A button on your Zoom app, and we will get to them during the end of the session. Please do not reshare the contents of this webinar without express permission. A recording will be available afterwards on the registration page and will be sent to all registrants. And with that, thank you, Vinesh and Raghav, for being with us today. Maybe you both can give us a brief introduction of your background before we dive right into the topic for today.
Sure. Thanks, Val. Hi, everybody. I'm Vinesh. I'm the founder and CEO of ExtractAlpha. I'm a quant by training. Started my career in the sell side in equity research, and then spent a number of years at a company called Starmine as the head of research. We were analyzing the analysts, trying to build predictive analytics for on top of equity research data, I think, which will be very, very relevant for today's talk. Then spent a lot of time in prop trading in New York. Most of that time was at Morgan Stanley at a desk called PDT, where I was just running systematic portfolios based on a variety of different data sets and on a variety of different horizons. And then founded ExtractAlpha in Hong Kong in 2013, and here we are. So run the quant team here and sales and marketing and the rest of the organization out of Hong Kong and our global sales presence as well. Happy to go into what ExtractAlpha is, but I guess first intro over to you, Raj, right?
Sure, Vinesh, thanks very much. And thanks, Val, as well, for kicking it off. So just a very brief background. I'm a math and CS guy by education, but I've only worked in finance. I started my career with Citi. I think Vinesh spent some time there as well. And within Citi, I sort of rotated across different parts of the equities, institutional equities business of the investment bank. And I think I really saw the increasing participation of hedge funds, especially US money, into Asian markets in the 2000s, and was sort of very closely involved with some of those setups into Asia. I left Citi towards the end of GFC in 2009 to start an institutional boutique brokerage of our own with a few other partners from other investment banks. That was a business called Aviate Global. We were very successful. And a few years later, we had a nice exit. I continued to grow the business with the new owners for the next several years. And then finally, in 2015, some of us left and we came together to start Smartkarma. A very, very simple mission. We wanted to make it simpler and easier for investors to gain access to the best minds in markets through simple subscription-based cloud-hosted networks. And that's what Smartkarma is today. But we'll get into that shortly. Vinesh, back to you.
Sure, great. Thanks, Raj. And yeah, I think what you described about Smartkarma is kind of relevant because there's some similarities to what ExtractAlpha does. So really briefly, what is ExtractAlpha? So we are an alternative data provider and a quant research firm, both of those things. And what that means is that what we're trying to deliver to our clients is a select bespoke set, or I should say, curated set of data sets and signals that are designed to be easy to use and additive to institutional investors' investment processes. And these are all done or built from the point of view of a systematic investor. So we basically look through lots and lots of data sets, try to identify which ones might have value using really very similar techniques to what might be done in-house at a lot of the top quant firms. And then when we identify that value, we deliver these data sets either as raw or as signal-based data sets to our clients who ingest them as data feeds. So it's a data as a service business. I can give you a couple of examples of those, but we'll be going through those examples later, in the presentation as well. But one key one is a company called Estimize that I've been involved with since its early days, which is a crowdsourced platform for earnings estimates. So you or anyone else can contribute earnings estimates, and then that data is collected from the crowd, and then under the hood is signals are built out of that are then sold to quants, and that's a business that ExtractAlpha acquired in 2021. As you can see on this page here, there's a variety of different data sets that we do offer to our clients who are almost entirely quants of some form or another, hedge funds, asset managers, trading desks, asset owners, and so on. So that's sort of ExtractAlpha, I guess, in a nutshell.
Thanks, Vinesh. I can sort of share a similar intro of Smartkarma as well. We'll just put up a little slide there too. Great. So, while ExtractAlpha is a data platform or a data as a service platform, as Vinesh described, Smartkarma sits on the other end of the same value chain. We're a research network or a research platform. We bring together independent research providers, or as we like to call them, insight providers, that collectively produce over 17,000 insights a year. And these are then consumed on the other side of our network by professional and private investors through our cloud-based platform. And what's unique is, instead of paying multiple different subscriptions, one of the unique values we bring to our clients is a single subscription model. So Bloomberg, in our early days, sort of called us the Spotify of research, and that's sort of something that has struck as the business has grown. Today, as it stands, the supply of research on Smartkarma comprises of about 300 different insight providers. We carefully curate them for their expertise and differentiation. And at the end of the day, we're looking for providers that are data-driven, that are very differentiated, and they also focus on dollar-dense content verticals. The other thing that's fairly unique on Smartkarma is that our insight providers receive payments that are directly linked to their share of consumption. That creates a very unique merit-based ecosystem, which is very, very different to the traditional sell-side research models that have prevailed for the last many years. Today, our client base consists of about 250 global institutional investors. Majority of these are on the active equity side. In addition to that, we also have a product for private individual investors where we have a few thousand investors. We've recently also branched out into serving corporate investor relations teams. And there's about 3,000 Lisco IRs that are now on the platform and use the network to outreach to their ultimate shareholders. The sum total of all of this is that we've built a very, very unique asset that has a very rich data exhaust, which we think can be harnessed by smart, systematic investors. And that's, I guess, why Smartkarma and ExtractAlpha are working together, and we'll sort of share some of the ideas that we've been working on together recently. So back to you, Vinesh. Yeah,
that's a great intro, and I'm sure we'll go into details about what that collaboration looks like. We'll have some slides on that as well. But I think there's probably a good time to dig in a little bit to what's special about independent research and the research and the insights that you're collecting. I mean, I've been looking at equity research data for a long time, over 20 years now, and back when I started, research meant sell-side research, and that was it. And then 2003, the Spitzer settlement comes around, and 10 banks are required to essentially subsidize independent research, and that sort of kickstarted things, at least in my view, or at least in my awareness of independent research. I mean, we even did a project for Fidelity where we created a signal based on independent research providers back then, and there weren't that many. There's Morningstar and Argus Research and a handful. Apparently, that score that we built on independent research still exists somewhere buried in the Fidelity website. But that's sort of the beginning of this evolution, and then sort of broadly crowdsourcing, if however you want to use that term, research from a variety of different sources has become something that's of a lot of interest to people. So I think I'd be curious how you kind of characterize what the differences are between traditional sell-side equity research and the independent providers that work with you.
Yeah, I think that's a really, really good question. I think at some level, and I'll start off with the wrong answer first, but at some level it is the same, because it's probably the same people at the end of the day who are doing the research. So Smartkarma as well comprises of analysts who at some point of time either worked on the sell side or on the buy side. Were highly experienced, but felt that they were not getting the type of distribution and independence they wanted to make sure that their work gets the amplification that it deserves to have. So that's sort of the first point. But the second point is, and that's probably where the similarities end and the differences begin. So what are the main differences? If you look at the sell-side research model, increasingly, and I'm not saying always, but increasingly, the sell-side research model serves the corporate finance client base. It exists to serve deal making. And as a result of that, it is sort of conflicted by definition. It is not as much agency focused as it used to be at some point of time in the past. And I don't need to belabor that point. I think everybody sort of agrees and acknowledges that point. The second thing also is not only is sell-side research focusing more actively on the corporate finance side as opposed to the buy-side client base, but also there has been an increasing focus on juniorizing and cost cutting and maybe even outsourcing and offshoring the production of research. And that's been very, very easily observed by the declining engagement rates that traditional sell-side research receives now. So again, lots of stats out on it, but most of the research that gets produced by traditional sell-side doesn't get consumed or read, let alone engaged on more deeply. And then the third part is sell-side research also gets wall crossed on transactions, which means that actually when there is an asymmetric event unfolding around an underlying security that the analyst covers, more often than not, at that very precise moment of time, when you can add most value to your end client, you're actually wall crossed on a transaction and you're embargoed from writing research. So there are unfortunately a lot of constraints that are only increasing that apply to that traditional sell-side model. And when we were starting Smartkarma, the one fundamental truth that we saw that the world didn't quite fully see yet at that time was that there is no way that expertise can be confined within the glass walls of an investment bank. There was a fragmentation of talent and expertise that was underway well before we began in 2014, 2015. A great example of that is the rise of expert networks like GLG. So you were already starting to see the active investor branching away from the traditional incumbents who were producing more and more commoditized research to other unique sources of input. And what Smartkarma did was we became a catalyst, an accelerant, an agent that further propagated that change that had already begun. And we started off with an APAC focus because Asia is extremely fragmented. The US and even Europe to a certain extent are more monolithic when it comes to research. But in Asia, even if you look at the same sector, consumer in China is nothing like consumer in Japan or India. So you really needed an on-the-ground network. You needed credibility. You needed quality. And you needed to build it because it didn't exist. And you're absolutely right, Vinesh. Independent research providers did not exist at all in Asia when we were kicking off. And the reason was because nobody had built a platform where these guys could exist and they could monetize. So it was a very arduous journey for someone who was a senior analyst at a top investment bank to leave and recreate the sort of distribution and pay at the end of the day that they would receive. So with Smartkarma, our mission became to really foster a community of the best minds in markets and give them the sort of distribution that they would need in order to still continue to serve a highly professional audience. And I think the internet, cloud computing, technology existed. Spotify existed when we started, and we just needed to apply some of those same principles to research.
Yeah, totally makes sense. And, I think we have a very similar worldview in the sense that, observing sort of that stranglehold of the sell side on research getting loosened over the last, 10 years. That's reflective also in what we do with crowdsourcing earnings estimates, right? Like, that's not a platform where there's any constraint in terms of who can provide that quote unquote research. In our case, it's a numerical, point estimate of earnings. Yep. But, we track contributions from professionals and non-professionals. We do not find the non-professionals to be any less accurate, and so that completely makes sense. There's sort of the democratization. And I think there are a lot of parallels in that democratization in terms of the broadening of what constitutes, data that systematic investors consume as well. Historically, what were the data sets you'd use? Well, it was a lot of sell-side data. It was, basically IBES plus, some fundamental data from, let's say, CompuStat or WorldScope plus pricing data. And now, obviously, it's much more than that. And you can kind of think of this proliferation of data sets almost like, each data set captures some sort of an opinion about a thing, about a product, a company, a stock, whether that's an explicit opinion, like what we see in your platform, it's a buy or a sell recommendation effectively with the rationale behind it, or it could be the opinion embedded in a news article or management's own opinion embedded in an earnings call. We do a bunch of NLP work on capturing the sentiment of those earnings calls. Or even consumer sentiment as well, and looking at sort of transactional data and web data as well. So all these sort of sentiment type of things, there's someone's opinion, and it's not just the bank's opinion. And also reflected in the data, some of the things you talked about, the biases that are kind of embedded in the sell side data. I mean, you can see clearly now, 20 years after the Spitzer settlement, I don't know what percentage off the top of my head of sell side buy sell recommendations are actually sell, but
I think the number is
not a
about
lot.
8%. It's 8%, I think now.
Yeah. And in your database, I forget the number. It was a lot. It was like 30, 40. It was something. It was a lot.
40, close to 40, yeah.
Yeah. So you can, you can say that that's just people's optimism, but clearly there's a difference in optimism between these two populations of, researchers. So clearly some things at work pulling that optimism up on the sell side. And I think, we kind of are acknowledging what that is.
Yeah, and I think the final point I'll make is a point that's extremely important. It's a point about incentives. What is the incentive structure for an analyst who's sitting with a broker, sort of a bank or broker today? I think it's a very, very different incentive to someone on Smartkarma. An analyst on Smartkarma doesn't get paid because they're pushing deals. They don't get paid because they served or they subsidized another internal department within the bank. They only get paid if they're adding value to their clients, which in our case are investors. So, we in fact have built our own metric called quantified value add, which is a real-time transparent metric that literally computes your value to the rest of the network. And that's the basis of all payment on the platform. And I think that creates a totally different community, a totally different incentive structure, and at the end of the day, different outcomes. And I think if you really want to change behavior, you've got to change those incentives. And I think that's why, and I think your data and studies have reflected some of that as well. There's a very unique kind of sustainable alpha in the type of work that comes out of an independent research community.
Yeah. No, absolutely. And in fact, I remember reading a survey some years ago. I think it was an institutional investor, but it was asking the buy side, what do you value? It's not just asking the sell side, asking the buy side, what do you value in sell side research? And the ability to make, let's say, accurate earnings estimates or good calls in companies was way at the bottom, actually. I mean, it was, top was access to management, things that do come from having an investment bank, but that just means that the research itself, the written research, the recommendations, the earnings estimates, that's really not what they're being compensated for, and the incentives aren't there to improve those things, really.
Yep, exactly. Yep.
Yeah, and it's also why we see a big, differential across analysts and researchers in terms of how good they are doing these things. I think one of the really interesting things we found in looking at your platform was that we could identify a track record. Essentially, we could look at the insight providers on Smartkarma and really identify some that where consistently, if they upgraded a company, it would outperform over some kind of horizon, let's say a month or a quarter. And those are the same people quarter in, quarter out. So there's definitely some true measure of skill. And I think that's probably much more true in an independent research community than it is among the sell side.
Yeah, exactly. And I think another small point sort of I wanted to make is that Smartkarma can allow for a little bit more diversity in the type of talent onto the platform versus what presumably a typical sell-side institution would do or have the ability to do today. And I think by allowing that creativity, we can sort of surprise ourselves and surprise our clients and create the type of content verticals that just don't exist previously. And we've done that quite successfully. I think Smartkarma's got probably the best event-driven research product around Asian markets, for instance. Similarly, we're building out one of the best forensic accounting-based research product, or a ECM research product covering IPOs as well as placements. And I think a lot of these were ideas that were surfaced from the network. And by having those extra degrees of freedom, we allowed research entrepreneurs to foster in those areas that met those unmet needs as well. And again, then the output that you get out of that creativity is, is clearly filling a gap that just cannot be served by the traditional vendors.
Yeah, no, very cool. And you can see that reflected in, in the data as well, that there are lots of different content verticals that you covered, and a lot of them are fairly unique. And there's everything from, there's macro research, there's quantitative research, there's credit research, there's all these different verticals that could, really fill in the picture. Yeah.
Yep.
Yeah. Maybe it's, good time to talk a little bit about what we built together.
Maybe I'll start because,
Sure.
you really solved a bit of a problem for us. And that's a good place to begin. As the Smartkarma platform was growing and attaining critical mass of, customers, once in a while, we would get a reverse inquiry from a systematic manager or a quant fund of some sort who really wanted to get certain different types of information from us, as opposed to access to read written research or engage in conversation with analysts in a high touch manner. They wanted a signal or they wanted a data set. And frankly, as a firm or as a platform operator, we didn't have the expertise, the bench, the data bench that was required to take what we had got and, sort of curate and repackage it in order to address some of the needs of interested systematic investors. And I think that's where we started talking about a year back, right?
Yep.
And I think you can maybe share a little bit more about what we've built now at the end of that journey and how it might, and we can chat about how it might be helpful to quant funds.
Yeah, absolutely. No, I mean, I think this is a really, interesting combination of, unique content and sort of the quant horsepower that we have at ExtractAlpha. So, very natural kind of collaboration here. We started looking at it and, very quickly found that there's something there. And then the challenge is turning it into something that is, that'll be interesting to the buy side, to quants in particular. I mean, one of the, I mentioned that what we do in-house is very much like what quants do in-house, but there's an additional layer to it, which is that our intent is to commercialize, right? So we're not going to build a black box model that's very complex and hard to understand. We're trying to build something that we can explain to people. It's really going to be almost like the equivalent of what a discretionary analyst would do when they're reading the reports, but in a systematized way. So yeah, I mean, I guess I can show you a little bit about what this thing is. Let me share my screen again. So we built something called the Independent Research Provider Sentiment Signal, or IRP Sentiment Signal. And I'll just skip right ahead to what we're doing. So we're looking at the Smartkarma content and we're saying, okay, well, what is that content if you view it as data? So everything is data to us. We view the world in this lens. And some of that data is structured, some of it is unstructured, and that is true on Smartkarma as well. So what's structured in it? Well, what the research is about. Is it about a particular ticker? And we're mostly looking at stock-specific research here, entirely about stock-specific research. So we have the ticker. We know when the report was entered into the system, so that's structured data. Obviously, we know the person who wrote the report, an identifier for them, and that's all. And we know whether it's bullish or bearish. So a provider has to say whether the report is bullish or bearish, and we have that tag. So that's all good. And you can build something very simple on that, saying just like, okay, well, I'm going to just, look at all the companies where most of the recommendations are bullish and just go long those and short the ones where they're mostly bearish and so on. And that's actually not a bad thing to do. And you can build a simple sort of, quote unquote signal out of that, but you can go a lot deeper because of the richness of this data. So we found a number of features in it, which we thought are useful and we built into the signal. So first is, and I'm just going through these kind of bullet points down here at the bottom. How old is the insight? If it was published yesterday, it's probably more valuable than if it was published a year ago. And that's sort of a natural and obvious thing. Is it a reiteration or initiation or revision? So we're really mostly, intuitively interested in new opinions or changes in opinions. And, a reiteration, you like the stock 6 months ago, you like it again. Okay, maybe you like it for a different reason, but you still like it. And it's not really a change in your sentiment. So let's maybe be a little bit less interested in those reiterations and more interested in, I'm initiating coverage. It's a strong buy. It's a buy, not a sell. Or I was pessimistic, now I'm optimistic. That's even more interesting potentially. And then next is what I mentioned earlier, the track record. So we're able to quantify whose prior insights were, I don't want to say market moving, because that's not necessarily the case. We're not talking about causality here, but were correlated with the subsequent risk adjusted return in the stock and relative to peers in the same country and sector and so on in the past. So we can say, okay, this person has a good track record in predicting stocks generally across their coverage, and we can put more emphasis on those new insights from those providers with better track records. And then finally, this is getting a little bit more subtle. Basically, I mean, these reports are bullish or bearish, but we can get more subtle than that. We can say, what does the text really say? So we can look at the rationale. So these providers put in a rationale, it's several paragraphs long potentially, and we can actually systematically measure the sentiment of that rationale. And we've done that using a natural language processing model that we've built in-house at ExtractAlpha. It was originally designed to capture the sentiment in earnings call transcripts, as I mentioned before, but we've kind of repurposed that here, and we can get much more subtle and identify, text which is relatively more bearish or less bearish, or relatively more bullish or less bullish. So we can kind of combine all these different features and come up with something that that we think is pretty predictive of stock returns over the next couple of weeks. I mean, this is not something that will tell you about the next year, but it's sentiment after all, and sentiment changes. But we built this thing, and what we're essentially doing is we now score every day. We take data from Smartkarma, we run all these calculations, we spit out a score 1 to 100 to keep it really simple and easy to understand. And we could just basically score every stock we can in the developed APAC universe. So currently this covers a lot of Japan and Hong Kong, but other markets as well. And then, so this is a bit about the coverage of this particular signal by country. So you can see, Japan is in blue, Hong Kong is in orange, gray is South Korea, and so on. And okay, well, we've scored these stocks. Well, what happens next? Maybe you want to know what would happen if you started trading these signals. Now, I'm not suggesting that anyone trade just this signal by itself, but if you were to, just as an example, what would happen? And so we just built some simple sort of long short portfolios where you're going long the most bullish stocks according to our signal and short the most bearish. And you rebalance each day, let's say, and you generate some kind of return. Let's assume this is before transaction costs, because everyone's transaction costs will be different. In reality, you wouldn't trade it this way anyway. You'd probably, if you're a quant investor, you'd add this to the 3 or 10 or 50 other signals you're using, and you get some return. And that return looks like the green line here, which we always like to see lines going straight up from the bottom left to the top right. We see that here. And we've got, this goes through the end of last year, but we can sort of track the annualized returns that are sort of in the order of mid-teens most years, and overall sort of 30% return to the Sharpe ratio of 1.3, which is quite good. And you can see that broken down to Japan and Hong Kong, which are the two most covered markets here as well. So that's pretty promising. I should backtrack a bit and say that when we were building this, we didn't just look at all this data and try to optimize this green line going up and to the right. That's obviously a dangerous thing to do. You're snooping in the data if you've done that. So we did use pretty strict in and out of sample sort of testing techniques and hypothesis testing before we sort of came up with this set of features and the parameters. And it seems to have worked out pretty nicely. I don't know, Raj, if you want to comment on anything I've just said there.
Yeah, I think, I'm just sort of recapping the iterations that we did and sort of the conversations we were having. And as I mentioned, a lot of what you guys did was sort of outside the usual day-to-day remit of us at Smartkarma. And I think we did a sensible thing of splitting our universe into developed Asia and non-developed Asia. And what that meant was that this particular signal is more amenable to market neutral strategies. As we all know, a lot of emerging Asian countries tend to be more long only markets with very, very difficult access to borrow and so forth. So I think that was good. And I think that makes this a lot more actionable for the type of clients that we want to reach out to with something like this. I think the second thing that I found, intuitively speaking, Japan did really, really well in the underlying data, as you can see. And we were sort of anecdotally hearing that even from the active managers that were subscribing to Smartkarma. They loved the strength of the Japanese product that exists. Most of the Japan coverage that exists out there in the market tends to be coming from, local domestic Japanese franchises. Sometimes there are language constraints, etc. Whereas Smartkarma had built a very, very deep English language speaking ecosystem of research providers who had also spent a lot of time on the buy side. So they were coming up with the type of research that was really quite valuable to their counterparts now. And I think the other part about Japan also that was interesting was just the extent of coverage we had. I think the largest bank covers between 400 and 700 Japanese stocks at the moment. And I think across Smartkarma, we're easily triple that, across everything. And we end up going a little bit deeper down the market cap list than a typical bank that focuses mostly on the large index stocks. So a lot of that meant a lot more diversity, a lot more variability of input, and I guess sort of what you would probably call richness of data. And it was good to see that what we sort of anecdotally knew from active managers tended to show up similarly on the data as well. With Hong Kong, I think we all know Hong Kong's been a very, very difficult market for the last few years for many, many different reasons, all the way from protests to sort of lockdowns to so on and so forth, right? But
tell me about it.
Yeah. But I think that in my mind, what we've been able to put together would be very valuable to investors who want to remain invested in Hong Kong, China, but do not want to take the type of directional bets that were more popular in the prior decade. And I think that's the direction of travel increasingly, based on the conversations I've been having with CIOs of larger asset management firms at the moment. You still want to remain in that market. It's 30-35% of MSCI emerging markets, but you're reluctant to be directionally biased to the same extent as you used to be before. So I think again that adds quite, this brings that capability to managers who previously were not necessarily looking at things this way. And I think the other thing we did, Vinesh, which was I think sensible, was we removed credit research.
Yeah, that's right.
From the data set. And that was, for obvious reasons, right? I think it was a very different type of signal. And we wanted to make sure that we're looking at something that makes logical sense as well. And that's what you meant by, we set out with certain hypotheses and sort of went along the way. And I think that the philosophy of both firms is to sort of continue to evaluate and improve and iterate as well. And I think you bring a lot of capability there, which I found. And I think, since we've done this, I've also had the confidence to connect you with some of our clients on the buy side who want to look into building signals, but they don't have the bench that you've built. And I think that capability set was we appreciate it a lot.
Yeah, no, likewise. I mean, I think I want to echo what you said with some of the markets in China A in particular. I mean, you're right. That's something we will keep an eye on, as it evolves. And we'll see as more research comes in that covers China A, we'll take a look at it. This is something that comes up a lot with our clients, and increasingly so. It came up actually quite a bit when I was in the UK last month, just visiting clients. I feel like China's a market where everyone's about 1 or 2 years away from want to really enter it in earnest, and that's been true for the last 5 years. So it's sort of a moving target. But on the back of that, we've been focusing a lot on building up more Asian and specifically Chinese data sets, based on client demand. We've built NLP capabilities for Japanese and Chinese now. So we're seeing a lot of that kind of demand starting to build more now, and I think that's something that we'll have to keep an eye on.
That's right, Vinesh. I think there's 2 points I'll add on that specific sort of China topic. I think the first is, a decade and a half or so ago, instead of APAC, Asia ex Japan became a popular mandate, and I think we're now seeing Asia ex China.
Yeah.
Asia ex-China, ex-Japan sort of becoming a market that at least is being requested for, a mandate that's being asked for. And it's a couple of reasons. I think some of the asset owners and allocators feel that they want to control the weight, the China weight. And they feel that China dwarfs everything else. I mean, once you put China in, Philippines is like 0.6% of the benchmark. I mean, it's ridiculous. It's not even a rounding error. So people want to look at some of these markets with a little bit more freedom, and hence China sort of deserves a conversation of its own. I think some of the stuff that Smartkarma is doing with that A-share universe is interesting, and possibly something we can delve into deeper in our next webinar as well. And I think that the second thing also I feel is that just by virtue of geopolitical developments over the last, 18 to 24 months, a lot of the China, there is a feeling that China is going to become a much more of a domestic market, or you at least want to focus on those stocks that will always have a domestic bid, as opposed to be exposed to stocks that may or may not have a foreign bid. And hence, if you want to stay exposed to Chinese consumption or the reopening of the Chinese economy, et cetera, but you want to play it maybe through the domestic shares, the A-share market, or maybe you want to play it through a LVMH, out in Europe and so forth. So you either want to go all domestic or you want to go complete proxy. And I think Hong Kong, as a result, is sort of being abandoned to a certain extent by the active directional managers, which actually I think makes it a lot more interesting for the systematic market neutral managers, because you're suddenly seeing slightly irrational departures from the market even now. And I also feel, and this is, and maybe we should talk about riskiness of some of the data approaches out there. I feel, and I've sort of said this for a while, I feel a lot of news and media coverage is now increasingly tainted. And, it's gone from garbage in, garbage out to being highly politically charged. And it sort of doesn't make sense. One of my favorite examples has been, throughout last year, there was tons and tons and tons of media coverage talking about how luxury demand in China has fallen off a cliff because of lockdowns and consumption's really bad. But when we were talking, and when I say we, I mean analysts on Smartkarma, we're talking to luxury car dealers or luxury watch retailers. Porsche sales were going up 100% year on year. Watch prices were going up, sales were going up, but news was completely the opposite. And, I think to a bystander, that's a very confusing picture. So I think the quality and credibility of the underlying source that's going into that data machine is going to be increasingly important. And at Smartkarma, we hold that sacrosanct. These research providers are all curated, they're onboarded, they're qualified, they're highly credible. In fact, a statistic that we share is that Smartkarma research providers are quoted at approximately 7 times per day, every single day, in top financial media. All the way from Bloomberg First Word to, end of day on an event, post-market. And I think that means that the signal over time is going to move markets more and more and more, because it brings that credibility with it, as opposed to maybe some news sources, which I don't know what the motivations there are now.
Right. Yeah, that's fair enough. Yeah, and we've definitely noticed, for the domestic Chinese market, it's also just a different beast for a number of reasons. I mean, difficult to short, obviously, capital restrictions, but also, the heavy retail participation in that market, which means your quant models are going to be different. For example, so coming from our sort of systematic perspective, not only do you need to sort of treat information sources differently, but you need to potentially build your models differently and focus on different types of signals as well. Which is true in all markets, even for particular names that have higher retail participation, we see things work differently, even within the US market, for example, but that is much more extreme in A shares. And that's just not going to change anytime soon. It's very, very gradually changing.
That's right. And for the domestic markets, a couple of the areas, maybe just hints again for a bigger conversation later, but we look at, we're seeing a lot of interest in index events on the domestic A-share market right now, because the markets are extremely liquid and very deep. So, And the indices now have more and more sort of following as well domestically, right? So the CSI series and so forth. And we keep getting requests for more and more index reval or index event type analysis, which I think makes for like interesting data sets. The other one is factor-based. I think, again, you mentioned high retail participation. Again, that makes it for very interesting sort of and simple in some way factor-based approaches in that market as well. And I think the third one, which is going to be, I think the next bigger thing there is, a few years back, we started with the northbound and southbound connects to sort of equalize Hong Kong and China. And I think now they're building more things. There's sort of renminbi scripts that have just started coming out in Hong Kong as well. So I think the move towards pari passu, I think is going to be a great opportunity as well in that market, which some of the data-based guys are going to be able to capture a lot better than anybody else.
That makes sense.
Awesome. Thank you guys for sharing all of your insights. And for the sake of time, perhaps we can round this off with just a couple more sentences and we're good. So a couple of questions from my end. So thank you both for sharing your insights on what the industry is currently doing and looking at, especially from what both of you guys have created together. I believe it's something that's very unique and it's something that no one has really seen before. So I would like to also ask from the floor, when you guys were researching on creating this product, were there any specific trends that you saw within the community itself and that you can see being prolonged for the next perhaps 3 to 5 years that could possibly be of a big concern?
Yeah, I mean, I guess, well, I don't know about a concern. I mean, we can definitely see, certain markets, the amount of research just increasing. And that sort of circles back to why we wanted to focus kind of on developed markets first. But, the amount of research, for example, in China, and especially I think India was increasing quite a bit. And I mean, Raj, I don't know if you want to talk about how the various markets are covered on the platform, but that was one of the clear trends where we said, okay, we need to kind of wait and see with some of these markets. But that was one that comes to mind.
Yeah, I think, I mean, yes, I think there's different types of crowding in the market. And one of my favorite examples of the last 2 years has been sort of crowding around ESG or absence of ESG. So, it's been such a sort of exclusion-based market for active managers. Not even going to look at this company because. Yeah. And what we have noticed is that ESG has gone from being seen as I guess people sort of forgot that ESG somehow has to be brought back in the context of alpha. Like it has to, at the end of the day, make money for the corporate, for the shareholder, for the portfolio manager. But there was this growing disconnect between what I must do versus what its end outcome and results were going to be. And that divergence is starting to come back around this year, where some of these names that were just forgotten for a while have started to actually be big outperformers. And we saw that last year, with energy leading the market, materials having a big move and so forth. So I think what we see especially with traditional sell-side research is just extreme crowding behind whatever the trend is.
Yep.
Huge polarizations, and then like no love for anything else at all. So I'm seeing the same repeated in many different ways now. There's an exuberance and enthusiasm around India right now, and a complete sort of detachment and divorce from the Chinese market, for instance, at the moment. And I think we, as an independent research platform, we exist to challenge that consensus, to constantly be mean variant, both from a quantity and quality perspective. And I think the way we're trying to do that is by making different research analysts who actually sort of publish on Smartkarma collaborate with each other. So think of Smartkarma also not only as a Spotify of research, but also as a GitHub of research. So these analysts can actually cross-pollinate ideas, they can cite each other's work, they can create product that fundamentally doesn't exist in silos, that only existed because people came together. You put a political economist, a macroeconomist. Sorry, that sounded like the start of a very bad joke. But yeah, you put them together and suddenly very, very interesting stuff starts to happen, right? And I think those are interesting opportunities to capture on the data and systematic side.
Yeah, no, I'll echo what you said about ESG as well. You know, we speak to asset managers. You know, it's always interesting, but it's very often, you know, it's negative screening, as you say, and it's not about alpha. You know, we're actually actively doing research on ESG alpha now, and it's, you know, that's when it starts to become interesting to hedge funds who never cared about ESG before. They're like, no, I don't care. It's not. I don't have a mandate. My mandate is to make money. Well, you know, maybe you can if the research is done right, but it's hard to do it right. So I think that's going to be an area of focus. It is for us at least, and I think that'll increase as well.
Yeah, I think the more Vinesh and I talk, the more I realize that, you know, whatever is interesting to you is also interesting to us. We're just sitting next to each other on that value chain.
Exactly, I think that's right.
Yeah. Great. Well, I think that's a good juncture to round up for today, unless there are more questions.
Yep. Nope. I was just going to say it sounds like a beautiful idea incubator. And, you know, like so I've heard from someone to say before, there's no harm in over communicating. So I believe it's the same here. Beautiful ideas can come out just by communicating with each other. And I love that. It's a great way to end today's session. So to end off today's session, perhaps both of you guys can just give a one-liner or a sentence to wrap this up from your perspective, or what you want to leave our audience with.
Yeah, well, I don't know if I could do better than what you just did, Val. That was nice. Look, I mean, I don't know. Obviously, we covered a lot of ground here. I mean, I do think that what I'd hope to leave people with is, you know, data and research are very broad topics. So you can find value in all these different pockets. But what I think both Smartkarma and ExtractAlpha have done is try to really identify very unique sources of intelligence that you kind of can't get anywhere else, and sort of collecting that in a way that it's easy and straightforward for investors of you know, all varieties to use. So, you know, to the extent that you're interested in learning more about those things, you can always kind of come to us. And then if you find an interesting source of information or data, we love to hear about those too. I mean, we get a lot of data providers coming to us and saying, hey, we think we have good data. Do we have good data? And we can try to help figure that out for you. So that's all obviously always an interesting conversation as well. But you know, Raj, I'll leave it to you to wrap up with any words of wisdom from you.
I think I'm going to leave everybody with one of the hashtags that the Smartkarma marketing team uses on our posts from time to time, which is, you know, hashtag moving markets together. I think that's at the heart of what we're doing, you know, as an independent community that's fostering the best intelligent minds to come together and have a sort of really meaningful, lasting impact on markets, and forgetting, you know, anything that held us back, any of the constraints, and really sort of forging the path ahead together. Like, that's the philosophy, that's the essence. And if that why makes sense to all of you guys, like, you know, give Vinesh or me a shout, or give anybody in that Smartkarma ExtractAlpha broader community a shout. We'd love to work with you. That's it.
Awesome. Thank you both so much for your time today. And that is our webinar. Thank you to all attendees for being with us today. If you wish to reach out to either one of them, you know where to find them on LinkedIn. You can check out an ExtractAlpha LinkedIn page, as well as the Smartkarma LinkedIn page for more information. If not, thank you once again to both Vinesh and Raghav. Goodbye, everyone. Thank you.